Welcome to India's #1 budget headquarters. Decoding key policies, delivering market-shaping insights, and unlocking the potential of India's growth blueprint. Beaming live from the CNBC-TV18 Motilal Oswal Budget Headquarters.
The Hang Seng trading with gains of just around 0.4%. The Taiwanese index, after the outperformance through the week, is now trading at the flat line.
Late last afternoon, she had moved the Delhi High Court. The Delhi High Court, however, had rejected her application.
You know, a 25 basis point cut is in the price. Markets are absolutely expecting it. Nifty 23,652. We've got the sensex, which is starting at 78,240.
Then Japan looked more interesting, and also China is looking more interesting at this point in time.
Unanimously to reduce the policy rate by 25 basis points.
Nifty is marginally in the green after ending marginally in the red in yesterday's trading session.
Keep liquidity surplus in the interbank system or just adequate?
The endeavor of Reserve Bank to provide as much liquidity as is required.
Hello and welcome to a fresh edition of Closing Bell. We are down to the last hour for the day, that's today, and of course for the week, and it's turning out to be a bit of a disappointing hour for the bulls, you'd have to say. Though the RBI has delivered along expected lines, we've got that 25 basis points rate cut. But I guess, Nigel, for the bulls, it was ye dil mange more. And they didn't quite get it, so some disappointment playing out today.
Well, that's right. And I think we got a couple of other big cues, right? This evening, you'll have the jobs report. And this one's going to be important to understand what's the trajectory with regard to the Fed. And the other big cue is over the weekend. And the street was believing that the BJP is going to do much better, which should be the case. But can they come out trumps is going to be important. So I think two big cues is what we're looking forward to. So maybe some bit of jitters ahead of that.
You know, absolutely, I take that point, but the markets completely looked through even some of the other positives that came in from the RBI policy. Let's pull up the Nifty and the Bank Nifty. Nifty is down about 0.6%. Bank Nifty is actually falling far more. It's down about 1%. And we're not too far off from the lowest levels of the day on these indices. So that's another sort of factor of disappointment. Will there be some reversal, some recovery by the end? Let's see, we have an hour to go. Why I'm saying the markets refuse to look through any positives is that there were some positives. The RBI governor promising, number one, the fact that this was a unanimous decision. It was, a uniform call by all members of the MPC. The stance has remained neutral. Maybe some will argue that the market would have wanted to see a change in stance to more accommodative. But there was commentary on providing adequate liquidity to the market as and when it was needed, but the market has ignored that. And for banks specifically, something that the banks have not cheered is the fact that the governor has very clearly stated that any change in regulation with respect to those ECL norms, expected credit loss, or even the LCR norms, or even the new sort of norms on project financing, all of that is getting pushed. There will be more consultation around it. So nothing is getting implemented starting the 1st of April. But clearly it's not been enough. And we're seeing the market down and out at this point in time. So the banks are down for sure. But it's not only the banks. Let's look at some of the other names as well. So Nifty losers, maybe we should just pull up the whole list of Nifty losers out there. Big stocks like ITC, SBI, TCS, ICICI Bank, a lot of your big heavyweights, Reliance, Infosys, L&T. So while it's easy to blame the banks, the fact is that you can't, only blame the banks because none of the other big boys are standing up. They're not getting counted at all. So there's a lot of downside pressure coming through. ONGC is the biggest loser on the index right now. The counterweights are actually, there we go. That's the contribution chart. So that's telling you it's not only banks which are on the negative side of that list. The counterweights are coming in the form of Bharti Airtel, obviously because of the good numbers. Trent is seeing a bit of a relief rally. And then there are some global-facing stocks, metals in particular, that are doing pretty well this afternoon. So names like Tata Steel, Hindalco, they're holding up, as are global markets. But yeah, it's been disappointing for the bulls.
Indeed. Well, let's get in Mitesh Thakkar. Mitesh, what are you making of today's action? Would you hold on to that positive stance or is it breaking down? And also give us a couple of picks.
Yeah. Good afternoon, Ajay. So, I've been advocating that some kind of positive buy should be maintained on the index. And also mentioned that in case there's volatility with the event coming up, we could even see Nifty, hit and test 23,400 odd levels, close to that. Now, there was this gap which happened on Tuesday, with that positive announcement, which is between levels of 23,380 to about 23,420. That's the support pivot which I was talking about. And if that gap is not filled, then I think we should again bounce back. Maybe it will take a few more days, but we should again try and test to 23,800. So I think this is a level which should be the final threshold, 23,400, 380 zones. And as long as that doesn't break, I think, I will maintain a positive bias. The levels of the Bank Nifty are slightly lower because the Bank Nifty gap is at about 49,400, which is roughly about 500 points lower from here. So therefore, focusing on the Nifty as an index.
Okay, all right. What about individual stocks?
On the stock side, again, I have one buy and one sell call. On the sell side is Atul Limited, continuously making newer lows. Sell here with a stop at 61.30. Look for a target of roughly around 59.50 to begin with, and maybe even lower levels. This is one stock which has been underperforming, as well as the chart structure remains slightly on the weaker side. And on the buying area is Bharti. It's come off the day's high, but the structure is much better over here. So Bharti can be bought with a stop at 1657 for targets of 1700, and then above a close above 1700 would be even better.
Okay, all right, got that. Thanks very much, Mitesh. We'll come back to you for some more trades and some ideas in a bit. Let's now also welcome in Dilip Bhatt into the conversation. Dilip, great to have you on. Speaking after a while, good to have you on Closing Bell. So let's get your stance on banks and financials straight away. I mean, the market's clearly disappointed, but I don't know if it was that bad a policy. Your thoughts, and what would you do with financial stocks? Any buys?
Good afternoon, Surbhi. I think as far as the financials and the banks go, I think we still remain pretty neutral even after the budget after the policy announcement by the RBI. Very frankly, I think, as what we all know, that this 25 basis point was factored in. But in my opinion, apart from the fact that the liquidity is the need of the hour, which is very, very loud and clear, and there was a very nice article written by Mr. Puri, the ex-CEO of HDFC Bank, on how to improve the liquidity. I think that, of course, that point is very well taken. But in my opinion, the disappointment for me would be that RBI also feels that next year the GDP growth will be around 6.7%. In my opinion, Surbhi, that if it is going to be around sub 7% or even just closer to 7%, it's not going to bring back the corporate earnings in any serious or in any big way. So we will be back to those pick and choose, and by and large there will be pace, and to use my very common word, it will be schizophrenic in nature, the economic performance. So coming to banks and the finance, I would still say that, yes, they look defensive from the current levels, but not too ready to commit to the banks or financials, or rather even to the markets at the moment. I would say that we will have next 5 to 6 weeks, which possibly will see more volatility and possibly will give some good opportunities.
Okay, that's as far as the take on banks is concerned. Dilip, then let's get your view on perhaps what has been the biggest debate of the week, and the stock of the week for me has really been Trent. Whether the best is over and done, whether it's time to unload positions and move out, or whether these are the kind of dips which you should buy into if someone is looking at keeping Trent in the portfolio from a medium term. What would your advice be? I'm sure lots of people have exposure to the stock, whether in their mutual funds or even directly.
So I think going by the performance and going by the way they are going to fare over this year and over next couple of years, clearly they are trending upwards without any doubt. And I think that momentum will be maintained. But challenge, Surbhi, of course, will always remain the valuations. How do you value the stock, especially at these valuations? Of course, it has corrected. It has seen a lot of volatility right now. And if you personally ask me, I will stay away from Trent for the time being. I would not be in a hurry to buy, because for me, I think the valuations look pretty exorbitant, pretty expensive. And despite the fact that the momentum will be maintained, the growth rate will be maintained, but not the valuations continue to remain very challenging. And so I would prefer not to look at the stock at the moment.
Okay, all right. Dilip, I wanted your view on ITC. That's one of the big drags on the word go itself. The stock has gone through that split where you have the separate listed ITC hotels, and that will be excluded from the Nifty. So we'll see some kind of outflow towards the end of trade today. But what's your view at around 430? Everyone thought that maybe no negatives in the budget, valuation-wise it's pretty okay. Things should look up, but actually it's seeing a lot of selling pressure.
Nigel, surely ITC is one of those stocks which probably has had a very good run-up, and maybe in the last 6 months or so, it has not done anything great, or maybe more than that, a little more than that. And possibly, I think over the next 6 to 8 months, possibly will not do much. Because if you see that the ROCs are good, the cash flows are good, without any doubt, all those things are in place. But once again, when it comes to valuation, I think the growth is a factor, because the growth is not going to be all that robust, especially if you see the cigarette growth. This time the cigarette growths were a little more healthier than what we normally expect. But on an overall basis, if you see some of the other verticals of the company, I don't think that they will really push the momentum of growth northwards in any decisive way. So for me, ITC, personally, I would say that one should hold on to the stock, keep on eating all the dividends that they give, and possibly wait for some more, the things to improve internally on the company's front as well as on the external front.
All right, Dilip, I request you to stay with us. Let's get the management of Solar Industries. The stock is quite nervous, post the con call. So let's clarify a couple of issues. We have with us Mr. Manish Nuwal, the Managing Director of the company. Hi, Mr. Nuwal. Good afternoon, and thanks a lot for joining in. Well, the street has got very, very nervous post the con call. Give us a couple of numbers. Your volume growth, now you're guiding for around 8 to 10%. Could you confirm that? And also, could you tell us, on this base, what kind of growth are you looking at for FY26? And what does it mean in terms of revenue growth? So let's get this out of the way. Volumes and revenues for this year and for the next.
If you talk about the revenue, if you look at my Q1 numbers, we grown by only 0.7%. And after the Q1, in Q2, we grown by 27%. Q3, we have delivered 38% growth. Q4 also, we are going to deliver 30% plus growth. So if you take all these quarters together, so our growth will be around 23% in revenue terms.
Okay, revenue. And what about the following year? 23% revenue terms, 8 to 10% volume terms for FY25. For FY26, yes, what kind of growth can you deliver? And also give us an understanding about margins, because that's held around 27%, 26-27%. So can you maintain this?
So if you talk about the margins, then at the start of the year, we said that we are going to achieve better margins, which means that in last year, we did 23.3% EBITDA margin. This year, we were expected to deliver around 25% something percentage in EBITDA margin growth level. And we said that we will do 25-26%. Actually, we are delivering around 27.5% as of now. And we believe that the same traction will continue in the next quarter and next year as well.
You didn't give us the revenue number, sir. So we'll say that from 26.5% you'll improve, but revenue growth for FY26, we missed that number with the volume growth?
Yes, for the next year, we are firmly believing, and based on our current statistics, we believe that next year the volume should grow more than 15%. And on revenue terms, now defense is unlocking, international subsidiaries are doing better. We should do 30% growth in the next financial year.
30% growth in top line in FY26 and 15% growth in volume terms in FY26. So those are the two big numbers to focus on. Can you, since you're talking about defense and the export market opportunities opening up, let's talk about this Pinaka multiple launch rocket system order, because this is what's generated so much of buzz, right? Now, the total quantum obviously is large. It's huge, over 10,100 crores, but this is over many years, I'm guessing. So how does it start flowing into the P&L? When do you book revenues? Just give us some more details around this. And apart from Pinaka, you had also very, very recently announced, a big MOU with the Maharashtra government, again, for defense projects. So I don't know if there's some linkage between Pinaka and this, or if they're separate. Just tell us a little more on how the revenue booking will be.
So in last 12 years, we were spending a lot for defense vertical, and we have expanded our product portfolios, which includes Pinaka as well. So after so much of hard work, we have received the contract yesterday, and the total contract is worth 6,084 crores. And it has two variety of Pinaka. and for each variety, there are different timelines for deliveries. So we believe that based on the contract, 80% of the value should be delivered in next 8 to 9 years, and rest all we will deliver in next 5-6 years. So in P&L side, it will start giving impact in the next financial year.
Next financial year, if you
26.
Okay, so I'm just repeating the numbers. The total value that will come your way, you said over 8-9 years, is about 6,084 crores, correct?
No, the total contract is 6,084 crores. Out of that, almost 80% will be delivered in 8 to 9 years.
No, is that entirely your share, or is it being split between? That's entirely your share, right? 6,084.
Solar's share.
Okay, got it. So, to what extent will the revenue recognition be in FY26? I'm guessing it starts slow and then kind of builds up. And if you could just clarify on this Maharashtra MOU as well on the defense side.
I think based on the contract in next financial year, we are expecting that it will be slow start in the first 1 or 2 quarters. From Q3 will pick up, and we should do around 300 crores in next years. And then from 27 FY, we should be doing around 500 crores plus every year for 8-9 years. And as far as the MOU with the Maharashtra government is concerned, like you are aware that our company has participated in many development programs. We are developing programs or products on our own. And recently we have successfully tried to a very large extent Bhargavastra. So we are working on anti-drone systems. We are working on variety of rockets to meet all those upcoming demands for next 5 to 10 years. The company has thought that we should expand our facilities, and that's why we have signed an MOU with Maharashtra government, which is around
just a quick question on defense. I believe defense is about 21% of your total sales mix right now. Now, with all these high-profile orders coming in, Pinaka, the other stuff you're doing with Maharashtra government, what will defense be as a percentage of your revenue, say in FY26? And then what does that do to the margin? I'm interested in knowing whether with these high-profile defense orders, whether your margin improves from 27% or is it margin dilutive, these large government orders?
Last year, our defense sales was only 7%. And in this year, now it is 17%. And as a result, the margin has increased to 27.3%. As we move forward, as defense sales goes up, definitely contribution from defense will be much better. And our international subsidiaries are also doing quite better than what we were doing in a couple of years back. So I believe that 27 to 28% EBITDA margin should not be a problem for our company.
Final question, Mr. Noval, before we let you go. The problem for the company is that the market capitalization has become so huge, right? So then justifying valuations becomes an issue. But I'm looking at an ICICI Securities note, and they are saying by the end of this year, you'll do around 1,250 crores, very approximately. But then because of this ramp up in business, they are expecting that in the next 2 years, that's by FY27, they are factoring in more than 2,000 crores of net profit. Is that gettable?
Sir, if you just connect these two dots, what I said, that in next year, our defense will pick up from the current level of say around 1,500 crores on annual basis level. If it picks up and expand more than 2,500 crores in next year, and our domestic and international market doing better. So if you club these two things with EBITDA margin of 28% approx, then definitely our profits will be around those levels, what you have said just now.
All right. You know, Mr. Noval, normally we would connect the dots, but since we have you on the channel, we rather confirm about that. So thanks a lot for joining in. You've clarified on a couple of issues. The stock had come off from the top because, the street's expectation was you would grow far higher in FY25, but you're saying FY26 will be even better than FY25. For the time being, the stock is more or less flattish. We'll watch out for these revenues, margin scaling up, and the big number, 2,000 crores of profitability possible in the next 2 years. That's FY27. Dilip Bhatt is still with us. Dilip, any view on this one? Solar Industries, the stock the last few years did very, very well, but from the top, actually, it's corrected a little bit.
Nigel, I think first and foremost, this company is really very well managed. And I mean, Mr. Manish Nuwal and his father, I think both of them have really managed the company exceedingly well without any doubt, and I think full credit goes to them. But I think, Nigel, valuations remain a challenge. But if one were to, we'll have to do a little more research on that. But if it's really talking about from, say, they're going to achieve 2,000 crores over next 2 years, I think this stock definitely merits a buy because their defense share is going up. The EBITDA is the blended EBITDA is also going up, and they're also showing a very smart growth. So possibly that will justify some kind of increased valuation. So I would say yes, this stock certainly looks pretty good, pretty interesting, and one can have it in the portfolio.
Okay, all right. On one hand, one would say that on a trailing basis, multiples actually are expensive. Even at 2,000 crores, I think it trades at around 40 times. But return ratios are good, and it appears that business potential as well is there. So the verdict, we'll have to see. But Dilip believes that maybe he's fairly positive on this one. Thanks a lot, Dilip, for joining in and giving us your take on all the stocks that we just discussed. Well, it's now time for the Growth Quote, a special initiative by Grow and CNBC-TV18 designed to provide you with valuable insights and strategies to navigate the market and make informed trading decisions. Today, we unpack the risk of speculative trading and the lessons learned in the aftermath of the infamous 2001 Ketan Parekh scam.
Speculative trading creates artificial demand and can inflate prices, often resulting in market bubbles. But one small prick and the entire illusion vanishes in an instant. Speculation is the reason 90% intraday traders end up with net losses.
Speculative trading dominates the market despite its risk is because of the lure of quick gains, lack of common sense, and there's obviously a lot of greed as well. Time after time, we have seen this cycle repeating. Right now, the money at stake is far higher and is of great concern at the moment.
The 2001 Ketan Parekh scam exposed the perils of unchecked speculation. Fueled by insider information and excessive leverage, Parekh manipulated stock prices to siphon off over 40,000 crore.
One of the biggest things that happened in Ketan Parekh scam was a kind of a narrative that got built. The hype was built so much that it ended up brainwashing the retail investors and traders. The biggest problem here was that while they were investing, the pump and dump scheme was happening simultaneously.
The crisis forced a reckoning, with the market regulator implementing sweeping reforms. Circular trading was abolished. A central fraud registry was created and stock options were introduced for the first time.
The scam definitely highlighted the risks of speculative trading and thereafter shifted the investors' focus to relatively safer and established companies. Investors became far more aware of the risks in speculative trading and the pump and dump schemes, though the markets post-2020 also need similar kind of awareness.
While the scam helped correct systemic issues, traders also learnt about the risks of speculative trading. Learnings from the Ketan Parekh scam helped India build a stronger, more resilient market.
Welcome back. Well, the markets have recovered a little bit from the low point of the day, so I think we should get the intraday chart up there. I think we are 50 points off the day's low, and the good news is the mid-cap index is almost in the green as well. So you like that in terms of a screen movement. Also, ITC is under pressure, but ITC hotels, keep an eye out on that one. We've been making this point briefly on closing bell itself that the volumes are very, very high. It appears those sellers, that got the stock by default, they appear to have cleared out, and that stock has now moved to the high point of the day. As I said earlier, it will be excluded from the Nifty as well, effective today. So some outflows, but it appears for time being, it's already getting lapped up. Let's focus on another, a big news point that came in today. SEBI has cracked down on Finfluencer. Ashmita Patel, Yash joins us to fill us in with more details on that. Yash.
Nigel, the order after the FAQs were released last week has come practically in no time. This particular order again is a crackdown when it comes to influencers and their unregistered investment advisory. The person involved here this time is Asmita Patel, or as she would call herself, the she-wolf or the options queen as well. This is an interim order come show cause notice from market regulator SEBI against Asmita Patel as well as Asmita Patel Global School of Trading along with 4 proprietary entities. The order comes after about 42 complainants send their complaints with SEBI. All these 42 people had taken the courses which were sold by Asmita Patel and their proprietary entities, felt cheated, reached out to SEBI with everything that happened to them, after which SEBI has taken this big crackdown on another influencer. What are the allegations? Unregistered investment advisory and research analyst services. Second, violation of prevention of fraudulent and unfair trade practices, which is known as PFUTP regulations. Defraud in connection with dealing with securities and mis-selling of services related to securities market. Imagine the extent of money which was being taken from all these people who subscribed to the courses. The money which was being collected was to the tune of about 8.5 lakhs, including GST, for a course which would span across 7 months, which gave them training in the securities market. As far as the order itself is concerned, SEBI has said that an amount of 54 crore will have to be impounded by Asmita Patel and the related entities. Importantly, the show cause notice doesn't end there. It takes the order a step forward by saying that please tell us and show us a cause. Why should we not ask you to disgorge an amount of 104 crore rupees? So an important step by SEBI as far as the influencer regulation and unregistered investment advisory is concerned.
Okay, all right. It's quite an amount as well that needs to be given back. Thanks, Yash, very much for that. With that, let's get back to the market. We have our next guest joining in. Rupen Rajguru, Head of Equity Investment Strategy at Julius Baer, is with us now. Rupen, great to have you on. So the market's been kind of, it's been a slightly disappointing day for the bulls because we had a flurry in the middle of the week where the market was taking aim at higher levels. We had 23,000, almost 700 on the screen. But there's not been much follow through. And now we've got both the, the stimuli, the fiscal as well as the monetary today. Where does it leave the market trajectory? What's your call?
Yeah, hi. Good afternoon, Subi. In fact, as I spoke with you last time around, this would be the year of consolidation and contra. So we would want the stock market, which was in a relentless bull run between 2020 and 2024, to take a pause. So earlier what was happening is that every positive news used to get amplified and used to get rewarded, and people used to ignore negative news. As we speak, what's happening is that any negative news gets amplified and any positive news gets easily forgotten. Why is this happening? 2 reasons. One, if you look through, at the end of the day, what does market look into? Market look into the earnings growth, and then it looks into valuation. So on both the accounts, we definitely require a pause, and hence I said consolidation. While you're absolutely right that the economy, which is witnessing, I would say, a little bit of cyclical slowdown with all the measures, be it on the budget side, to boost the consumption as well as by the RBI by a rate cut today, will help the earnings grow, but it will happen probably after a lag of 4 to 6 quarters. Till such time the earnings growth doesn't catch up, I think we would be into the zone wherein probably at every rise there will be some bit of selling which would be happening, and that's why probably market will remain in this range.
Okay, all right. Hi, Rupen. Good afternoon. Good to see you, Win. What are the top sectors, though, you're betting on? I think you were fairly positive on financials, banks, insurance. Tell us more and try to give us a hint in terms, if you're talking about banks, then what do you like from the banking space? The larger names?
So, hi, afternoon, Nigel. In fact, if you look through the entire correction which we witnessed in January, banking and to some extent IT were the sectors which were probably, so to say, the best performing sector. And from a standpoint of valuation, definitely banking is the sector which is trading at a valuation which is much lower than its historical average, and also vis-a-vis the Nifty, it is trading at a much lower level, both on the earnings and the price to book side. And we saw through the results, I think a lot of the big boys, be it the largest private sector or the largest public sector banks, they have demonstrated that the margin pressure is there, but not as much as what Street has expected. And at the same time, the asset quality, specifically on the retail side, I was also very positively surprised by the way the largest public sector bank, the retail credit stood out. So the underwriting skill also is far superior. So in uncertain times wherein growth is difficult and the credit cycle is probably not on your side, no, we would stick to the largest players out there, in that segment. So that's the segment. Secondly, yes, insurance is a sector which we like. And, the life insurance companies, while there was a lot of regulatory noise over last probably many quarters, we believe majority of the regulatory noise is now behind us. And the growth numbers have been pretty strong. And here, what are the type of companies we like? Companies which have a good, decent product set, has a very wide distribution network. So a lot of the insurance companies which have a strong banker partners. And at the same time, now if you look through, the non-par products, which is a high margin product vis-a-vis the ULIPs. With this rate cut, which we have seen, the relative attractivity of those products will come back. And we believe that, over next year, a lot of these companies will have some of these products which might kind of contribute meaningfully to their revenue, which will be aiding their margins as well. And also the protection, also growth is pretty strong. So all in all, insurance is a sector we like. And finally, I would say consumer discretionary, particularly after, the kind of fillip which we have seen. And if you look through in the budget, the maximum delta will come to people who are earning between 12 lakh and 25 lakhs. And that's the bracket wherein, will be having more money at their disposal. While they can consume, they can also save and invest. Here, the companies which are in that segment, be it the hotels, be it, the QSRs, and to some extent jewelry companies, all will benefit from that. So I think consumer durables as well. So that's the segment which we like, particularly after the budget boost.
Okay. All right. So, that's a thought. So, Rupen, leave us with some ideas. It's a difficult environment, slightly confusing, tough market. What would your biggest overweights be? And if you were to deploy some money now, first of all, would you go all in? Would you stagger it? And then the themes that you're most confident on for, say, the medium term, at least the next 6 months to 1 year?
So, Surabhi, in the current context, frankly, if you ask me, is there like a no-brainer buy or a sector or a theme which kind of looks completely like, decimated and, worth warranting a buy? The answer is no. But at the same time, within the sectors also, and hence when I said the two themes, one is consolidation and second is contra. So within each sector, there would be stocks which are trading, probably like within banking also, there are a lot of private sector banks which are now trading at, say, a 1P multiple, one price to book multiple over next FY27 book, closer to that. So when the environment improves, historically, those were, trading at closer to two multiple, now at 1. So those are attractive. Within pharma also, if you see, there are some companies on the CDMO side which are looking pretty interesting, very high growth. That looks good. And, difficult to pinpoint a particular sector per se, but one segment, which is beaten down, probably seeing some recovery, I would say, is chemicals. So post-COVID, I think, all these stocks had a variety of issues, be it issues around higher raw material prices, higher inventory, China dumping, and all those they have seen through those cycles. And probably this quarter, we have seen the earnings probably growth to be pretty good for them. And that segment is something which we believe can see a little bit of re-rating because it has seen a significant de-rating over the last 3 to 4 years.
Okay, all right, Rupen, appreciate you joining in. Thanks a lot for giving us your view on markets and all those stocks and sectors that we did discuss. Have a good Friday evening, good weekend, and we'll catch up with you rather soon. Well, let's focus on the other sector that's bounced back in today's trading session and tell you why metal stocks are shining yet again. First up, the RBI cut rates, the repo rates, that's likely to help the economy. So that's point number one. The second factor is the indications are that the rupee is slipping a little bit and it'll be allowed to find its own fate. A depreciating rupee actually is not so bad news because it restricts some imports and it helps the metal industry actually. So that's point number 2. Point number 3 is ArcelorMittal, the listed stock overseas. Well, that one was up close to around 12-13% overnight. And their commentary was very, very good. They have mentioned that the steel industry is at cyclical lows. They're also forecasting that, that demand ex of China, well, that could grow by around 2.5 to around 3.5% in 2025 in comparison to 2024. And for India, they were factoring in 6 to 7% growth. So that's good news. They believe that demand will be much better in 2025 in comparison to 2024. So that's the third point that we're talking about. Point number 4 is, again, there is these reports that are coming up that China is going to do something about their property market that has been very, very weak. And the commentary that came out there is that they're looking to get the real estate investment momentum back to speed as soon as possible. So that optimism on China is another point out there that worked in their favor. And finally, there is hope of some kind of protection that's coming in there for the steel industry. Some kind of anti-dumping duty, some kind of protection from imports as well. We have had Mr. Sajjan Jindal talk about it. We had Mr. Jayant Acharya that voiced his opinion as well. And the hope is that somewhere in the middle of February, we could hear something. So because of that, the steel stocks are doing well. So a few short points out there. If there is some duty that comes in there, you could see a price increase that comes about. In January, prices were still more or less flattish. In February, there's an attempt to push up prices. And keep in mind, global steel prices as well will have to recover from here on, because those Chinese producers that are not integrated, at these sort of spreads, they can't make any money. So the hope is, both globally and domestically, things should look up, which will result in an EBITDA per ton expansion as well. Explains why metal stocks are twinkling today.
Green, plenty of green on those names, Nigel. Thanks for that explanation and context as well. For the timing, let's focus on Mahindra & Mahindra. Good show, steady quarter. Let's go across and listen into the management.
Needed a price correction. We took something on 3XO, which was the first increase we took after launch. We also took something on XUV 700. So, we had a couple of price increases and we didn't really discount. Apart from that, as Amar said, there are multiple initiatives that we always do to get cost out, including material cost, and then that starts playing out. So it's a combination of all of these. Plus, of course, operating leverage, because it's a strong volume growth.
How's the discounting scenario now in Q4, the first month?
But there's no difference in the discounting, except that we always have to run something on a 2024 win, which is a standard thing anytime as you get into January. So if dealers are carrying some inventory of 2024, which is bound to be some inventory, so obviously there will be discounts running on that, but there's no other material change in discounting.
Understood. If I can squeeze in one more question.
Yes, please.
Mr. Barua, you mentioned that commodities have been benign, but steel, especially steel, now the government of India is looking for some kind of protective measures for the Indian industry. At least a study is going on. If that happens, just trying to understand steel as a cost of your overall expenses, what would your exposure be?
So I don't have an exact percentage, but what I can tell you is within steel also there are multiple grades, right? And the measures that might come into might not be as relevant from an overall, because there's a overall steel oversupply situation right now. So what is meant for more construction activity might not necessarily be the impact that we'll see in the automobiles. But I don't know, Rajesh, if you have a different...
I'll add something to that. 93% of our steel is procured from within the country. And
right, so I think I should clarify what I meant by the question is, if some duty measures come in and steel prices in the Indian markets also correct on the upwards trajectory, just trying to understand to that scenario, what kind of exposure would you have?
Yes, and I was getting to that second part later, which is our sense is the government will look at the impact on all user industries of steel, which will be across the board, and ensure that the specific problem which is around dumping, which is being looked at, is addressed, but the dumping problem shouldn't really translate into higher prices that impact all industries, because that will essentially take inflation up and take away some of the good work that's been done right now to provide a demand stimulus for the industry, for the economy overall. So that's the expectation that we have in terms of that balance, and we shall see how that plays out.
Thank you, sir. Mr. Jejurikar, if you can just help me with a number in terms of steel as a constituent of your bill of materials.
I think it'll firstly be very different for auto and tractors. for on the auto side.
Thank you.
Swaraj, you had a question, and Hormaz also, you have a question.
Thanks. The rate at which M&M is growing in the PV segment, it looks like you'll be fast running out of capacity.
That's a good problem to have.
Any plans of hiking it further from here on?
Yeah, so just to Swaraj, recap what we've said so far. We were at 49, we said end of last quarter, then we said we're increasing it by 5 for rocks. So that took us to about 54. Then we've added the capacity for electric SUVs, which takes us to whatever, let's say another 8,000-10,000, so mid 60s. And I think that now that is a good number as an overall SUV capacity. Now, like I said earlier, we have some specific product / aggregate capacities to debottleneck. So we definitely need more gasoline capacity on 3XO than what we have. We do need to increase some capacities on Thar and the 3XO portfolio. And these are small incremental capacity enhancements we'll do over the next 3 to 6 months. But right now we're not looking at any significant expansion capacity till we really see what is the balancing that will happen between ICE and EV volumes. We'll get a feel of that over the next 3 to 6 months.
And the arrangement, the contract manufacturing arrangement between MEAL and M&M, does this mean that M&M standalone will not make or sell electric passenger vehicles, and that will be, all such products will be the exclusive business of MEAL from here on? No electric EVs will be made within M&M?
No, the electric EVs will be manufactured within M&M and sold to Mahindra Electric. That's the contract manufacturing. So Mahindra Electric is outsourcing manufacturing to M&M on a contract manufacturing basis. They will be sold exclusively through MEAL, through the dealer network. Does that clarify?
Yes, got it. Okay. And just last question on the long stance that M&M has held on hybrids. Are we still sticking on to it, and that as and when the opportunity, if there is there, we can look at it? Or has there been a change of stance on that?
We are still sticking to it.
Thank you.
Hormaz, Nihal, will come back to you. There are quite a few. Yeah?
No, XUV 400 right now is still in M&M AD. Is not being sold through MEAL at this point of time. In Q4 as well. It's in M&M, not in MEAL. Hormaz?
Hormaz, do you have a mic? We'll come back to you after that. Yeah, thanks.
All right, that's Mahindra. And Mahindra, the management there, Mr. Jejurikar, fielding lots of questions. It's been a steady quarter for the company. Okay, let's go forward and quickly review the situation as far as the screen is concerned. It's not that bad. There's actually a good recovery in the market, you'd have to say. Look at the Nifty. It's trying to get back towards the positive side of the screen. This is not something to write off just like that. When we started the show, we were at the lowest point of the day. Bulls are fighting back. They want to have a good Friday. Let's take that break. Come back with more in just a bit.
Welcome back. Well, as we have been saying, the markets have seen some bit of a recovery. Let's get in Mitesh back on the show. Mitesh, good recovery is what you're seeing. That 23,400 mark that we were talking about, that's got protected, at least for today. Give us a couple of stock picks.
So, Nigel, I think that remains a very important level, and I still hope that that level kind of manages to sustain. As long as that happens, good chance that we will have seen some volatility and we will be ready for some kind of up move next week. On the stock side, BTST on Eicher Motors with a stop at 53.60 for targets of 54.20, and Colgate Palmolive is on the negative side. It's trading near the day's low as well. So STVT here. Keep a stop about levels of 26.30 and a target of 25.80.
Hey, all right. Got that, Mitesh. By the way, the top volume traded stocks in the last 20-30 minutes is ITC Hotels. Massive volumes, more than 3.5 crore shares getting traded out there. And it's going to be excluded from the Nifty today. That's the changes that will take place. The passive index adjustments, that's already been completed. But Nuvama, they have put out a note and they're saying, according to Nuvama alternate research, the outflow is expected to be approximately 90 million USD, which is approximately 46 million shares. And that's close to around 2 days volume impact. So for the time being, the volumes have gone berserk. But it seems as of now, at least all of that is getting absorbed because the stock, pull up the intraday chart of the stock, you'll see that it went up, I think, to around 177 odd mark. And then quickly it went to 170 as well. So bulk of this volatility is because it's going to get excluded today. So that's why there is that adjustment that's taking place. Slip into that break, come back. We'll wind down the markets for you. Don't go anywhere.
Welcome back. You're with us as we enter the last leg of closing bell, and it's turned out to be a remarkable fight back by the bulls, but still red is the color. That's what we have. We have Sudeep Bandyopadhyay joining in to take us through the last leg. Sudeep, great to have you with us. Let's talk about the best result reaction on the Nifty tally today, and that has to be Bharti Airtel. Stock's doing well. Bharti Hexacom, which reported numbers, is also doing very well, 11% up over there. So what do you make of it? Finally, the tariff hikes have happened and they're showing up in those ARPU numbers, Sudeep. What's the call on the stock?
No, absolutely, Surabhi. I think it takes some time to flow into the P&L, and it has started flowing in, and it's very heartening to see that ARPU hike and ARPU is giving to a better P&L for the telecom operators. Of course, I think in the commentary they were very clear that more hike in pricing is required to ensure long-term sustainability of the industry, and so which is a very clear signal that more hikes may be around the corner. That second thing which I noticed about Bharti is that the subscriber numbers which they are gaining, last quarter was not good for them, but this quarter the number of customers, incremental customers which they have got is very interesting, good number. So all the parameters, you look at any of the parameters, they have performed well. So of course, market is cheering the results. Also, I must say that the strategy of Indus Tower and moving assets back to Indus Tower is a good strategy because it keeps businesses clean and gives Indus Tower and Bharti also flexibility. So I think overall it is a good set of numbers, good corporate action, and even the commentary was pretty good. So all in all, I think is a good set of numbers. And to conclude, Bharti Airtel, even at current price, does look good considering all the components have started performing.
Okay, all right. Sudeep, short chat. Thanks a lot for giving us that take on Bharti Airtel. By the way, before we wind up, we just need to pull up Kotak Mahindra Bank. I think in the last 5 years, the stock has not even moved 20% in all of 5 years. And just take a look at the stock. In the last 1 month, it's up closer to around 10%. As we speak, that one is flying away, firing all cylinders. So that one, in fact, is calling for attention. There's a massive volume burst out there. That's the stock you should be keeping on your radar. Big move on Kotak Mahindra Bank, and it's helped the Nifty as well cut some of those losses. So that's the stock of the final hour. But let's run you through about market action today. ONGC is under the weather. Mr. Trump is talking about keeping a lid on crude oil prices. That's not very good news for them. That stock was down close to 3%. ITC valuations attractive, but no respite out there. SBI yesterday got away with a cut of only around 1%. Today the markets, the Nifty Bank was underperforming actually, and that one participated on the downside. Britannia as well, not such a good day. The stock was down close to around 2%. What did well? There's optimism. Something is going to come for the steel industry from the globe or from India as well, and that's why you have Tata Steel that's up close to around 4%. JSW Steel was higher in today's trading session. Hindalco, not non-ferrous, but maybe in fact liquidity will drive that stock up as well. So that as well did well. And a couple of good earnings reactions. Bharti Airtel, Mahindra & Mahindra, thumbs up, and Trent, after getting beaten yesterday, bounced back in trade.
Absolutely. On the mid-cap screens, some of the stocks that have really soared today include a Bharti Hexacom. Godfrey Phillips had a great outing. I don't know if it's just a rub-off on those good volume numbers from ITC or something else, because there's too much happening otherwise at a corporate level as well. with this company. JM Financial 6.5% higher, so that was up and about as well. Then you had names like Astra Micro doing well, Gulf Oil Lubricants reacting to numbers in the commentary, about 8.5% higher on that stock as well. Actually, even Castrol had a great day yesterday and a good week. So some of these lubricant stocks have had a good week, so to speak. However, on the losing side, First Cry saw a deep gash today. Brainbees Solutions, 9.5% gone from First Cry. MCure Pharma, a stock we don't talk about too often, down about 6% as well. BKG was definitely not tasting too good today, 10% lower over there. And NCC was another big result disappointment that was playing out today. Just sort of to complete the picture, Zomato about 2% higher, Swiggy about 2% higher, 2% lower, and PG Electroplast, great numbers, but how much is already in the price? That was the question. Stocks ending with a gain of about 3%. So the bell has gone. The week has ended with the Nifty around the 23,560 mark. A week of consolidation, digesting big events like the budget as well as the RBI monetary policy. That's where the team of Closing Bell will take your leave, but don't go anywhere because we have Editors Roundtable coming up after a quick break.